Private buyers are putting a $103 billion price tag on a company officially worth $61 billion, a 70% premium. Nobody's forcing them, but they're lining up almost 2-to-1 to get their hands on it. There's a mechanic here you need to understand. If you don't, you'll be flying blind every time you try to read a private valuation. Most pre-IPO companies right now trade at a discount to their last round. This one does the opposite. So why are buyers paying up before there's any public exit? What do they see that the last valuation missed? And why does almost nobody talk about this signal, even though it's hiding in plain sight? Hey, welcome to New Stock Signals. I'm Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. I read every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. You can't buy this stock, not directly, it isn't public. The company is Anduril, a defense tech firm building autonomous drones and AI-driven weapon systems. We'll come back to it, but the company is the example. The lesson is the mechanic. You need to understand what the premium is really telling you and what it can and can't say about the IPO that eventually comes. Institutions read this signal every day. Most retail investors never learn to. Zoom out with me. When a private company raises money, it sets a primary valuation, the official number, the price agreed in the funding round, $61 billion in this case, set back in the spring, but this number is a snapshot. It's frozen the moment the round closes. Meanwhile, life keeps moving. Employees want to sell some shares. Early investors want liquidity, and new buyers want in before the IPO. A quieter market forms underneath. The secondary market, existing shareholders sell to new ones. No company involvement, just supply and demand in real time. The primary valuation is what a company was worth on one day to one group under one negotiation. The secondary price is what another group thinks it's worth today, with real money right now. Think of it like this. The primary round is the sticker price on the window of the house. The secondary market is what people are actually bidding at the auction. When bidders push above the sticker and keep coming, it's a potential signal. This premium is the message. Anduril's last official round valued it near $61 billion. On the secondary market this July, shares traded around $116 each, implying a valuation north of $100 billion, roughly 70% above the last official mark. A premium alone isn't the signal. A premium can just mean hype. Thin trading, one eager buyer. Pre-IPO secondary markets are notoriously opaque. The signal is the premium plus the pressure behind it. On this name, buyers outnumber sellers by close to 2-to-1. Demand is outrunning supply. Think about what that means. When more people want out than in, prices fall to a discount. When more want in than out, and they're willing to pay a 70% premium, that's the market marking the last valuation as stale, too low, lagging the story. And in this case, the story is doing the heavy lifting. Revenue roughly doubled to about $1 billion, then doubled again past $2 billion the next year. Defense budgets are turning toward exactly this kind of autonomous software-first hardware. The buyers paying 70% up aren't paying for what the last round saw. They're paying for what the next 18 months might prove. These are signals of a market front-running a valuation that hasn't caught up yet. So what does a premium like this actually tell you? There are 3 things you need to read from it, and none of them say, go buy. First direction, below means sellers are winning. Above means buyers are. Doubt versus conviction. Always understand the direction first. Second, pressure. A premium with thin volume is a rumor. A premium with buyers stacked against sellers is a signal. Ask, is anyone actually filling these orders? One motivated buyer isn't a market. Third, the story underneath. Price without a reason is a trap. Price with doubling revenue and a structural tailwind is a thesis. The number and the narrative have to agree. So what do those mean for a potential IPO? First, it sets a floor on expectations. When private secondaries set a 70% premium, it's likely an IPO won't work off the last official round. Second, it raises the bar the debut has to clear. A rich private mark makes great headlines, but a daunting hurdle for an IPO. And the third, the quiet one. A persistent premium with real buy-side pressure may pull the timeline forward. When demand is running 2-to-1 and shareholders want liquidity, the pressure to give them a public exit builds. A stubborn premium could tell you the IPO clock has already started. The premium doesn't tell you to buy. It tells you what the public market will have to reckon with when this company finally rings the bell. Now let me argue against myself. because you should be skeptical. Isn't this just fear of missing out with extra steps? Sometimes a premium can absolutely be a crowd getting excited. This is why the pressure test matters. Real two-sided volume separates conviction from a mob. The secondary price isn't even real. It's an estimate, fair and true. Private prices are less precise than a public ticker. Different platforms quote different numbers on the same company. I've seen this name marked anywhere from the high 90s to over 120 in the same stretch. So don't treat any single figure as gospel. Watch the trend and the direction, not the decimal, and the honest one. None of this predicts the IPO price. A rich secondary mark does not guarantee a rich public debut. Plenty of hot private names came public and gave it all back. This is a tool for reading conviction. It is not a crystal ball. It's about discipline. The signal narrows the field. It doesn't hand you the answer. So here's what you walk away with. The official valuation is a snapshot. The secondary market is more like a live picture. When real buyers pile in to pay a premium, it could be the market saying the old number is stale. But direction, pressure, and story all have to line up. They tell you where to look, not what to do. The lesson here isn't to scour private secondaries for the hottest names. It's about understanding what trading in these markets means. The goal is to read the signals most investors never learn to see. If this is the kind of thinking you want more of, subscribe. Like this video so it reaches other serious investors. And if you want the framework we use to break down IPOs before they move, it's all in my book. Pre-orders linked below. This isn't about chasing headlines. It's about building a system that still works when the noise fades. When real buyers pay up and keep lining up, the last valuation is already history. Your job is to read what the market's saying now.